2024 is going to be a very different market to last year. But I guess last year was very, very different to the year before and the year before. That's how property markets work. So why do some property investors outperform others? And that's part of what we're going to discuss in my chat with Brett Warren today when we talk about whether property investment is an art or a science. We're going to help you understand what you need to know to take advantage of the changing property markets that are going to come over the next months. This stage of the property cycle, previous times around, has been when lifetime wealth's been created, but you've got to know where and what. I've been around long enough to be able to make some patterns out of the chaos, so I hope to help you today. Now, regular listeners would know that we usually produce 2 shows a week, but during January we're offering you 3 shows a week, a combination of new shows to keep you up to date with what's happening in the world of property and money and the economy, but I'm also going to be replaying some of our previously published shows, and that's what's happening today. So while the fundamentals of what I discuss with Brett Warren are relevant, this show was initially produced a while ago, in fact, in the end of 2022. So there will be some things that we talk about that are not exactly right for the current property cycle, but they'll become very clear as I discuss them. But the reason I'm doing this is because there's lots of new listeners to our podcast. I know this because I see we've got tons and tons of new subscribers. In fact, we've hit over 5 million downloads for my podcast, a milestone I'm very proud of. But while you've probably listened to a few back episodes, you probably haven't gone back far enough, and that's why I want to share this particular show with you so that by the end of it, you're going to understand what created property booms in the past and what I believe the next property structural shift is going to be that will create another significant property upturn. So, welcome to today's show.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
It's often asked, is property investment an art or a science? How do you become a successful property investor, considering the fact that most investors, 90% of investors, never get past their first or second property, so they don't get the financial freedom they deserve? Well, let's discuss this with National Director of Metropole, Brett Warren. Hi, Brett.
Hi, Michael. Good to be with you.
Now, I know you've spoken to investors, helped investors, mentored investors for well over a decade now. So what are your thoughts? Is property investing an art or a science?
I actually think it's a bit of both, Michael. I think it's necessary to understand both sides of the equation. You need the research, the facts, the data to help make the decision. But on its own, it's probably not enough. You're going to need that on the ground level experience. So you need to bring that data into a more, knowledge-based system and give it a level of perspective in order to make the best informed choices. So someone may be looking at data and always make their decision based on data, but the trick is also knowing how to action that and bring it in with that practical experience in order to make an investment decision.
I think there's one bit more. It's actually also perspective. And I think that's one of the reasons why currently a lot of the economists and analysts are getting their forecasts wrong, because they're sitting in their offices looking at spreadsheets, looking at models, some of them created by the Reserve Bank, that say if interest rates go down a particular percentage, affordability goes up, and so people are able to borrow more. And they're now doing the reverse. If interest rates go up, affordability goes down, so the property market's going to crash. What they're missing out on is the fact that the property market is actually people, not numbers and figures on a spreadsheet. So it's much more than just science, isn't it?
Well, that's a really good point. And I think also, Michael, we talked about cognitive bias before and really focusing on the data that you want to tell the story. And we can relate that to the bigger picture economy because the sky's falling in when the interest rates are rising and inflation's rising. But in reality, jobs growth's low, the economy's going fairly well. And on a micro level, investors always favour the data that they want to tell the story. So it's quite interesting, isn't it?
You're right there. So you need to complement the data, as you say, with local area knowledge. So that's why at Metropole we actually have property strategists who do the hard work and the data and the research and planning things, but actually using the perspective to understand it. And then the people on the ground, which is the art part, I guess. But over the years, I've actually come across 3 different types of investors. Maybe we should just have a look at those. And people listening to this should think, hey, where do I fit into this? Because you'd wonder which sort of investor would do better in the long term. So the first group is the passive investor. These are the ones who spend very little time doing any due diligence. They just buy one of the first properties they come across. They're not really interested in understanding all the ins and outs. They don't spend a lot of time learning about tax, finance, the law, compounding. They just buy with their emotions. They get involved in their investment decisions based on where they want to live, where they want to retire, where they want to holiday. In fact, a lot of investors fall in that category, don't they?
Yeah, we see that a fair bit. I think there's some big statistics obviously suggesting that most investors have bought close to their home because of that level of comfort, or they haven't really taken into consideration, a lot more of the due diligence, as you kind of mentioned before.
Okay, so that's one group of investors. The other one's the active investor. Now, I know you see those a lot too. They put in a lot of work to find a good investment. They do the due diligence. They get a good team around them. They got a basic understanding of what's going on and tax and finance. And then we get the very analytical people, those who, well, they're the exact opposite extreme from the passive investor. They spend hours doing the research, the due diligence, different spreadsheets. I think they sometimes go a bit overboard and they examine the data, they look for advice, they read all the material they can. And you would think that in general, those people, the analytical investors, are more likely to be successful. But that's not usually the case, is it?
No, because it is the science part, isn't it? And that they don't have the art part to combine it. And in this environment, Michael, the analytical people are probably, analysis paralysis. They're waiting for the right time or waiting for the data to pinpoint an exact moment. When in reality, and even when they find that moment, they don't have that perspective at ground level we were, speaking about.
That's a good point. So people are wondering what's the data showing, rather than stepping back and taking a big picture, a telescopic view. They're looking at it with a microscope. Now, that doesn't mean you shouldn't do research. I believe you do, but you've got to look at the macro factors, the big picture, and then drill down to the micro factors. And that's because we know that location is going to do 80% of the heavy lifting, and then choosing the right property in that location is going to do, I guess, the other 20% of it. And I know that at Metropole, when we've changed a couple of decades ago how we do things, looking at not just what happened in the past, which is what most people are doing. Most of the research you're seeing is looking at the past. What we're really looking for is in the future. That's improved our performance personally as investors, but also that of our clients. So we look at a number of different areas, Brett. Maybe you should just go through those.
Yeah, I think it's important to understand also, Michael, we follow the big trends. So we're not looking for micro factors or hotspots or whatever may happen. So a lot of the bigger trends we focus on are demographics and population growth. And I know we always say 80% of people who are moving to the country are moving to where the bulk of the jobs are, and that's along the East Coast. We're looking for the economic and employment growth to continue. And one of the factors in Brisbane's resurgence at the moment is that employment growth. We're finally getting some jobs growth, and that leads to wages growth. And that's significantly important. A lot of investors analyse wages growth, but I think that's really an important tool to analyse because people can
even more so now, Brett, where affordability is an issue for many people, but not for those with higher incomes.
And you find that they often can push house prices up. In a downturn, they recover much quicker. And Michael, we always talk about the importance of rising incomes with your rent, and the ability for your tenant to pay higher rents is going to get you to your end goal faster. Infrastructure growth is also important, and supply and demand's equally critical. And as we speak about, I mean, people focus on these things in isolation, like we spoke about before, but we have to tick all of these boxes. There's no point buying a new airport or a new university somewhere where it doesn't have the economic and the wages growth, and vice versa.
Sure. So you want to have multiple growth drivers because we want multiple factors to drive it, which you're not in general going to get in the smaller regional locations. Now, there's no doubt that over the last boom, regional Australia did better in general than capital cities, but we shouldn't compare a town of 300,000 people or 20,000 people with Sydney or Melbourne that have got 5 million people, or Brisbane that's got a few less than that, because the bottom line is we're not buying the Sydney or the Brisbane property market. You're buying individual locations within that market. But recently I read a blog from somebody, and it just reminded me when you talked about the confirmation bias, who pointed out how they've got a bias towards regional Australia. And I remember them mentioning that as buyer's agents, they've never bought anything more than $500,000, which means they've missed the big capital cities that we're talking about. So, yeah, they'll say that 20 people moving into a regional town will move that property market. Yes, it will. But 20 people moving into a regional town is not going to be the same as hundreds of thousands of people moving into Sydney, Melbourne, or Brisbane, or the big infrastructure development that's going to happen in southeast Queensland because of the Olympic Games. So I think you're right. Don't fight the gorillas. Don't fight the big picture. So again, we're talking about what sort of information we want to do. And the most commonly reported data seems to be auction clearance rates and also median prices. How useful do you find those?
Look, that's a really good point. As we said before, we're looking for long-term fundamentals. So I think, things like auction clearance rates, median prices, it's technical data. It can change from week to week and month to month, and it doesn't help when you're making long-term decisions. So it's a good time indicator, but long-term trends are obviously more important. Median houses don't really give a true reflection of the suburb as well, Michael. I know you always like to use your suburb as an example, where you've got properties by the waterfront, properties further in, and the distance between the most expensive and the least expensive, there's quite some distance, isn't there?
Sure. So I guess we're mentioning those because they're the most commonly reported ones. Auction clearance rates every Saturday evening, Sunday morning. And yes, the trend is important and they give a good indication of what's going on. But at Metropole, we don't try and outperform in the short term. We want to outperform in the long term. So it goes back to what you were saying a moment ago about long-term trends. So we do pay attention to that. But median prices are useful in some suburbs where a lot of properties are much the same, but in certain suburbs where there's apartments, houses, townhouses, villa units, some close to the beach, some on one side of the main road giving different figures to others, means that when there's a diversity of properties, median house prices are not a very useful indication. So currently, for example, median house prices are dropping. But if you look at the nature of the properties selling, a lot of the high-end properties in our capital cities are not being sold. People don't need to upgrade their trophy homes. So the thinly traded markets at the upper end, the more expensive ends of the market. So there's fewer high-end properties selling, which means the median price is going to drop a bit. And that doesn't mean that the value of your and my house has dropped. So I think you're right that they're two areas we don't look at. So what research strategies do your team at Metropole use?
Well, we talk about the top-down approach, Michael. So, we start by looking at the macro factors that drive our markets and drill right down to the micro. So the first thing is that the macroeconomic environment, how's the big picture in Australia? How's it looking? How's the economy performing? And despite what the media is trying to drum into us, it's not the end of the world. The economy is looking reasonably strong. I mean, we've got rising interest rates and things as well, but everyone's got a job. No one's, being forced to struggle to find a job or anything like that.
And even though the economy is slowing, because the Reserve Bank's wanting us to slow us down because of inflation, it is still growing. We're not going into recession, and it's not growing as quickly. But you're right. I think if we thought a recession was coming and people were going to lose their jobs, we'd say, hey, just hold off for a while. But that's not the case.
No, it's not what we're saying. So once we've got the bigger picture, then we're going to break it down to states. And I think as we keep talking about, we're looking for the right state in which to invest as we get back to those long-term fundamentals. Where's the economic growth happening, the population growth, the wages growth? And then obviously we're not looking in those regional areas because that's where the bulk of jobs, aren't being created. I mean, our bigger employment hubs in Sydney, Melbourne historically. Brisbane's starting to get a bit more growth there. And then within that state, Michael, we look and break down each suburb, don't we? So we're looking for suburbs that are the best suburbs that outperform the long-term averages.
And that's related again to what you said a moment ago, demographics. And again, it's not a judge of people, but there are four different groups of suburbs. There are the high-end suburbs, the more expensive suburbs, which in general don't always make the best investment grade locations because they're the ones that I guess a bit more volatile. Then there are the gentrifying suburbs that we like, where young people are moving in, millennials are moving out of apartments, moving into homes, townhouses, more affluent people are moving in, and we like those suburbs because you're not fighting the big trend. You've also got the people moving in there with higher income, not just the tenants, not just the landlords, I should say, but also the tenants. And then I guess there are those affordable suburbs where a lot of people say you should invest. I know a lot of the young group of buyers agents are saying buy in around the medium price in affordable areas. We tend to avoid those.
We do. We want to buy in the best streets and the best suburbs of those suburbs. And if you ask your viewers, your listeners, Michael, as well, I'm sure they know in their suburb there's a really, really good part of the suburb and there's an average and a poorer part of the suburb. And in many cases, we don't buy in those areas. We don't buy at the median or below the median because we're getting an inferior asset. We want the best areas, the best locations. And I think recently we did an audit of our clients, Michael, and even around the country, we've outperformed the market. Brisbane, for example, has done 30%. Of a lot of our clients have done upwards of 40%. And
capital growth.
So capital growth, absolutely. So that's how you outperform the market, by identifying the suburbs and then getting into the best streets and the most in-demand pockets.
Now, that's not hotspotting because if you outperform one year, that's not going to make as much difference as the continual capital growth. And that's really why we're not looking to buy cheaply at the moment either. So we're seeing a window of opportunity at the moment of getting into the market, but not because things are cheap, but because you can actually get into those good suburbs without as much competition as a year or so ago. So yes, we've got that top-down approach of choosing the right suburb, the right location within the suburb, and then the right property within the suburb. And regular listeners will know our six-stranded approach at Metropole, so I'm not going to bore them other than to quickly run through. We buy properties which have got owner-occupier appeal because it's owner-occupiers that drive the markets. We buy properties with below intrinsic value, so we avoid new and off the plan where there's just too many fingers in the pie and the cost of those properties are too expensive. Now, interestingly, I was watching something on Instagram yesterday, an Instagram reel, where somebody was telling how it was a property marketer explaining how they buy land and then you can go to the developer and they'll build a house for you and you're manufacturing capital growth, an expression we've used for a long time. But they missed out the fact that everybody along the way is making money, and one doesn't always equal two when you're building new homes in new estates. So yes, we like areas where there's a high land to asset ratio, and yes, we like buying properties that are going to grow well. But having said that, it actually shouldn't come at a premium, especially in today's market.
Definitely. Look, we see it all the time, don't we? Especially with off the plan and house and land packages and things like that. I think we're entering a very dangerous time, and we're already starting to see those kinds of valuations come back and not stack up quite regularly.
The other thing, of course, is the location of those. So they're often in the new outer suburbs. And there's no doubt that the cheaper outer suburbs outperformed over the last couple of years. A rising tide lifted all ships, but it's unfortunate that they're the areas that were more hit by COVID. They're the areas where the locals didn't do as well. The wages didn't go up anywhere near as much as the value of properties did. And we're already hearing stories of young families who bought into the market with 5% deposit because of government schemes, 10%, and are now having negative equity or can't actually afford to keep up their mortgages. So I can see those house and land packages in the outer suburbs being areas that are going to have some hurt over the next year or so.
Definitely. The other thing we want to do, Michael, is if we're looking to invest in a property for the next 20, 30 years, I'd really like to understand the long-term historical growth of that location, that area. So if I'm buying into a new property, there's no precedent. I don't know the historical growth. I don't know how it's going to work during a GFC or a flood or a downturn and a recession. So it's really important that history does leave clues.
It does, doesn't it? And I think the other thing we like is properties with a twist, something special, unique and different. And if you buy in those new estates, they all look the same. They may have slightly different coloured bricks, but that's about it. Look, I'm going to offend somebody, Brett, but in the old days, I used to say the only way you knew which home to go to was because you had a different colour Commodore out the front.
The good old days.
but no one has Commodores out there anymore. They're all four-wheel drives. And we like buying properties to which you can add value.
Yeah, look, Michael, getting back to the research part, and our research at Metropole's found some interesting reasons behind the most recent property boom, and it's probably worth discussing those.
Yeah, look, before we talk about the most recent boom, it's probably worth looking back and giving it some context. We did have a once-in-a-generation property boom, and the value of most properties around Australia increased 20%, 30%. And as you said, some outperformed, and we were lucky enough to find those for our clients. But actually, it wasn't luck. It was the homework, the research, the art and the science. But that wasn't a normal property boom. We're not going to have another one of those again for quite some time. So every now and then, though, we do have a very significant property boom, a major structural shift. So what created the one we've just been through was not just the lower interest rates, and everyone talks about that, but it was also a combination of things, including pent-up demand. If one goes back a bit further, in 2017, APRA tightened the screws. You may remember 2016, there was concern that 50 to 60% of all the properties being bought in Sydney were bought by investors. That was a speculative boom happening, and APRA nipped it in the bud, stopped it, and made it harder for people to borrow, particularly investors and also foreign investors. But when you stop people, it actually creates a level of pent-up demand. And then we also had pent-up demand not being able to move because of COVID. So the last boom we had was a significant structural change of releasing the pent-up demand you could get out, as well as very low interest rates. But I'm actually old enough to have experienced a few of these significant structural shifts.
Yes, probably a few more than I have, Michael.
Sure. Well, when I first started investing in the 70s, one big structural shift was high inflation. We had, like now, we actually had very high inflation. The Whitlam government came into power. Now, I didn't understand anything about economics in those days. I just bought right close to where I lived, close to where I went to school, where my mum went shopping. I still lived at home with my parents. I was a student and I went halves with my parents. One of the big things that changed was finance. In the 70s, women went to work, banks started to accept their income as second income, and all of a sudden it gave the average household twice as much borrowing capacity. And so the structural shift of more finance capacity and underlying inflation created an amazing property boom, which I didn't fully understand. I just bought a property and went up so much in value. 3 years later, I could refinance and buy another one. And I thought, hey, why hasn't anyone told me about this? Now, unfortunately, I think some others who've gone through the last boom, last year or two, some beginning investors are going to think the same. But the Reserve Bank and some of the increasing interest rates is going to change their mind on that as well.
Most definitely. Absolutely. And the next one was obviously the 1990s, Michael, with the deregulation of the bank and the non-bank lenders coming in to allow people to borrow a lot more.
That's right. That was a big shift as well. And it was started by Aussie John Simons and Aussie Home Loans, where before you used to have to put a suit and tie on and go to the bank manager and stick to their criteria. There was a period of time where building societies lent money as well, but it was really the banks that controlled things. And if you didn't fit in with their criteria, you couldn't. But again, that was a big structural shift. You're right, Brett, that all of a sudden people had more borrowing capacity, and that led to a significant property boom in the late 90s after the recession we had to have. And then there was, again, I think it's worth remembering these things to see what's going to happen in the future. In the early 2000s, we had a mining boom, and that created significant wages increases. And again, when people had more borrowing capacity because of wages, not just people in Western Australia, it gave them the capacity to borrow more. And in the early 2000s, we had another significant property boom.
Yep. Well, wasn't it interesting, Michael? I can recall because I was living in the West in the early 2000s, and I think at one stage we were betting on the Sydney house price versus the WA house price. It was level pegging, wasn't it?
It was. You're right. Perth houses cost as much as Sydney houses, the median price. And then the world changed. And then we had the global financial crisis. I think this is interesting looking back. You can see that every 10 years or so, the world breaks. The global financial crisis, the tech wreck in the early 2000s. But we've also got to remember that even though the world does break, it actually fixes itself and we get back to normal again. In the late 2000s, we had another mining boom. And after the global financial crisis, Australia became a preferred destination for a lot of people, a lot of foreign investment, especially from Asia. They saw Australian real estate, residential real estate in particular, but also commercial, as being very cheap compared to back home. And that meant that we built a lot of those apartment towers and foreign investors were outbidding locals for properties, and rules changed and they were only then allowed to buy new property, which led to another property boom, the boom of building a lot of apartment towers. And booms always lead to the next downturn because we built a few too many and then there was a bit of a slowdown. And then again, I guess it brings us back to what we just experienced, the significant structural change of 2021 when interest rates dropped and huge government stimulus to stop us falling into recession at a time, as I said, when there was pent-up demand.
It was a bit of a perfect storm too, wasn't it? Because we were saving more than anything. We weren't travelling. I know a lot of us were spending a lot of money on online shopping. Some of us more than others, Michael. But
I actually remember there were two sort of days, because I lived in Melbourne where I was locked down for 260 days. So there were days when you did the online shopping and the postman got to know me by name. He'd ring the doorbell, wouldn't come in. Hey, Michael, I've got a parcel for you. So there were days you got parcels from online shopping and there was days you threw out stuff that you bought online that you didn't really need.
It was an interesting time. But look, it is all very interesting. But what do you think and what do you feel is the next big structural shift, Michael?
I think that's a good question because we're now moving into a period of lower capital growth. We had that boom. Will another one happen? Yes, it will. Will it happen next year or the year after? No, it won't. Does that mean you shouldn't invest? No, because when you look back over the decades that I've been talking about, there has still been good capital growth in between with booms interspersed by downturns. But I see the next big structural shift being when baby boomers in particular and their parents, a few of people left in the builders generation, die off. And it's been suggested that there's going to be a significant transfer of wealth. And there's been various estimates. I know McCrindle, demographers, and we've had Mark McCrindle on our podcast a few times, talked about, he's suggesting there could be a $6.2 trillion worth of wealth transfer in residential real estate to their families over a decade or so. Now, if you think about it, Australian residential real estate, there's about $10 trillion in the property market. By the way, people talk about how much debt there is. There's only $2 trillion worth of debt against that. Now, I say only $2 trillion, but when you look at the whole residential real estate market, that's a 20% loan to value ratio. It's not overly geared. But when you think about it, it makes sense that a large portion of residential real estate is currently owned by the older generations because they've been there for a long time, the baby boomers and some of their parents as well. And so on that basis, as they die off, they're going to transfer the wealth to their kids and their grandkids. So various studies have estimated that there's going to be an amazing wealth transfer. And Australia's Productivity Commission suggested that there's going to be a fourfold increase in inheritance over the next 20 years. It's been estimated baby boomers will pass on an estimated $224 billion each year in inheritances by 2050. So we're not dying off any time soon, in case my kids are listening to this. I'm going to be around for a long, long time. Yeah. But it is going to, over time, create a significant transfer of wealth. And sure, some people are going to spend it, but others are going to be able to have that to invest and reinvest. So there's going to be a very significant structural shift that's going to create a wide range of young people who are going to have more money. Now, Unfortunately, this is also going to create some social problems because the rich are getting richer. But we're already seeing it in a different way, Brett. Some people are not waiting to give with a cold hand. They're giving with a warm hand now. And so the Bank of Mum and Dad is helping lots more people get into the property market. Now, it's been estimated that the Bank of Mum and Dad has helped almost as many people as some of the big ANZ, Westpac, CBA, Combanks as well get into the market. And that's probably the way a lot of young families are going to, the only way some young families are going to get into the property market now. And I know I've helped my kids. My parents weren't able to at the time. So I think it's important to create your own wealth first, put the oxygen mask on first, but then part of Metropole's aim is to help people not just grow and protect their wealth, but pass it on to future generations.
Certainly. And look, I often tell our clients, Michael, the discussion I always have with you in your proudest moment is the fact that you're already looking after your kids, but now you've passed that down to your grandkids. And, I know you get a lot of joy out of helping them with the school fees and other things as well.
Sure. So we started off talking about, is this art or science? And we sort of got sidetracked on this. Not sure how, but I think it was actually a good discussion to understand that over the long term, the market trend is up. Currently, in the short term, it's down, but that's just part of it. And I remember years ago reading that the wise King Solomon had an inscription on his ring, so he would never get too confident during the good times, too complacent during the good times, or too despondent during the bad times. And the inscription in his ring said, "This too shall pass." So I see a window of opportunity at the moment. I believe that at the moment, the media and the continual conveyor belt of bad news means that a lot of people are concerned about the markets and they're sitting on the sidelines waiting for I don't know what. This is the art and science bit, but they're one day going to realise, hey, interest rates have peaked. They're not going to keep going up anymore. They realise that, hey, inflation, the Reserve Bank's doing its job, it's coming under control. Now, I don't know exactly when that's going to be, Brett, but I would be suggesting that early next year, interest rates are going to peak. They're probably going to go up another % or so. I think at the end of this year, inflation will get close to 7%, and then we're going to realise it's going to peak. And when people do realise that, not doing anything now is creating a level of pent-up demand, just like being locked up in COVID created a level of pent-up demand, because people are still going to get married and get divorced and have babies, and they're going to want to move house and upgrade. And so all those things are going to come back when fear disappears and greed starts to overtake it. So currently, there's a good window of opportunity, not to rush in, but to get set and do it when it's right, because I know you often talk about don't pay attention to what the market's doing, get into the market when it's right for you.
Yeah, certainly. And look, I prefer to be negotiating and getting good opportunities without the competition. I think that's a good time at the moment. I think you'll be buying, probably better than you were 12 months ago and probably better than you will be in another 12 months, as you kind of mentioned.
Now, again, it's not because properties are cheap, because if you buy something now, even if it drops a little bit, what's going to happen is you're going to look back in 3 years and 5 years' time and say, hey, that was really a bargain. I believe why you should be buying now is because you're not going to have as much competition. I mean, our buyer's agents are still having trouble, though, because I know that there is still a shortage of A-grade homes and investment-grade properties out there, Brett.
That's right. And sellers are certainly sitting on their hands a little bit as well.
Well, they don't need to sell.
Yeah.
There's not desperate sellers, so there's lack of good stock. But that means that we're not rushed and forced to do this. So if you're wanting to plan, if you're wanting to take advantage of this window of opportunity, I'd suggest you go to metropole.com.au, find out about a range of services, and it all starts by putting a strategic plan together. So we help you plan to become the person you plan to become, and then we'll help you implement the plan. And I guess that's the combination. We started right at the beginning, Brett, of art and science, putting the two bits together. And if you'd like to understand how you can do this, I'd suggest you go to metropole.com.au, leave your details. And Brett, would you be happy to have a chat with these prospective investors?
Yeah, I think it's a great time to have a chat. I mean, we don't have to take action yet, but I certainly think getting your ducks in a row is a really good time to do that.
I also think it's a great time to assess your portfolio and see, is it actually going to get you to where you want to get to? Is it a good time to fix up problems, to prevent problems, and to improve your return? I guess that's what we need to do. And in this market, you actually need safety. There's so many people out there wanting to give advice. Everyone's got an opinion, but they don't necessarily, in my opinion, have the right to give you advice because they haven't been around the block often enough.
No, well, we got back to those stories about yourself, Michael. 40, 50 years, you just can't beat that level of experience.
Sure, and the frameworks that the team at Metropole and you use are the frameworks I've fine-tuned over 5 decades and we've been helping people with for over 20 years. Well, Brett, thank you for your chat. I love our regular catch-ups. Now, we catch up once a month on the podcast, but we speak almost every day. So I look forward to catching up again real soon.
Yeah, it was great. Thanks again, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to spend a couple of minutes talking to you about failure and why some people overrate failure, because the bottom line is we're all going to have successes in some areas and failures in others. And hey, I'm a real success at failure. So I got it both ways because I've had more than my share of failures. And if you try to become successful, whether it's in business, in personal relationships, in property investment, things won't always go right. So don't let it get you down, because failing is never permanent. I know you got that sinking feeling in the tummy, but it won't last forever. So the best way is to reflect on your failures and focus on the lessons that you've learned and the person you're going to become, rather than spending your time trying to avoid failure. Because if you avoid failure, you're never going to try things, and that's going to stop you being successful. So the less time you spend on the rejection, the faster you're going to grow. I think another important factor is to own up to your failures. The moment you openly talk about the things that make you vulnerable, they no longer have power over you. People will appreciate your honesty because everyone knows what it's like when they've had setbacks, when you make mistakes. In fact, they're going to respect you for owning up to your problems and embracing your failures. You become stronger in their eyes, but you also become stronger in your own eyes. Now, an important message that's come through many of my mindset messages is that the world won't change unless you do. Remember, the world owes you nothing. It was here first. So you can't blame your shortfalls that are happening in your life or the people around you or your past decisions on things that are happening to you at the present. It's not the event that defines you. It's how you choose to react to it. So forget what others say. They're going to judge you anyway. If you want the world to change, you have to change first. You've got to change the way you think. Remember, your outside world is a reflection of your inner world. Your thoughts lead to your feelings lead to your actions lead to your results. Now, Steve Jobs once said it cleverly. He said, if you don't love it, you'll fail. So my question to you is, how badly do you want it? Whatever it is that you're after. Remember the story about Thomas Edison. He made 1,000 or so unsuccessful attempts at inventing the light bulb. But from his perspective, he didn't fail 1,000 times. The light bulb was the invention with 1,000 steps to get there. So my question to you is, what are you after in your life that you're now going to have to just keep doing that little step by step, failing sometimes, getting a bit closer till you get there? And remember, when you do fail, and you will, just because you fail doesn't mean you're a failure. Never let failure deteriorate your self-worth. If your head hurts, you don't say, I'm a headache. You say, I have a headache. So failure is nothing more or less than an event. Don't personalize it. And remember that failure is part of the process to success. The fastest way to become successful is to double your failure rate. Successful people have failed more times than a beginner has even tried. So, the bottom line from today's message to you is, if you want to succeed, fail faster. Now, I don't know who you are listening to this, but if you're S. Wiley, who's left a 5-star review for me on Apple Podcasts, firstly, I'm going to read it out, and then I'd like you to email me, michael@metropole.com.au, and I'd like to gift you one of my books as my way of saying thank you. I used to do that before, and it's a habit I've gotten out of, so I'm going to do it again. So, first of all, if you've enjoyed today's show, and you know somebody else who'd get some benefit from it, why not tell them about it? because I'd like you to help me in my quest to make more Australians financially fluent. We're going to run into some challenging times ahead in our property market, so the more people that understand what's going on, the better. And if you'd like to tell the world, as S. Wiley did, I'd like you to leave a review wherever you're listening to the show. Anyway, the review I'm about to read out says, excellent and considered commentary. This podcast looks at all aspects of property investment and the economy. A really enjoyable and comprehensive podcast to subscribe to. Highly recommended. Well, once again, thank you so much. I love getting the reviews, and they're almost all 5-star. I see a 4-star one there as well, but hey, thank you so much. Now, I'll be back again real soon. You can catch me on social media in between these shows. Look for Michael Yardney, or join my private Facebook group. Go to Facebook and join the Property Update private Facebook group. Also, as a way of saying thank you for subscribing to my podcast, I've got a gift for you. Go to podcastbonus.com.au, www.podcastbonus.com.au, where you can pick up a heap of ebooks and reports as my way of saying thank you. I'll be back again real soon. In the meantime, have a great week and make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?